Hello, my name is Anup Maheshwari. I'm the Head of Equities and Corporate Strategy at DSP BlackRock Mutual Fund. So let's start off with a bit of a background on the markets. Clearly, as most of you will know, till about 6 months ago, about the middle of last year, 2012, we had a situation where there was a fair amount of despondency overall in the economy. We had a government that wasn't seen to be doing very much. Business confidence was generally very low, with a lot of projects being stuck. We had a fair amount of global uncertainty as well still prevailing. And by and large, the overall environment for equities was fairly poor. Clearly, since then, we have noticed a fair amount of change in the last 5 or 6 months. We have a scenario where, post the new finance minister coming in, the government is seen to be clearly a lot more proactive. We have seen them make efforts, particularly to stave off any de-rating or reduction in the rating by the rating agencies on India's sovereign rating. And clearly they seem to have a lot of earnest in their current process of reforms, which we think are being done in a more sustainable, more structural manner. So clearly that has been one change that the market has experienced over the last 6 months. And as a result of that change, we're now beginning to see a bit of a pickup in business confidence. We think GDP growth, which was slowing down fairly significantly, is now more stable. Now, all of these changes clearly do take time. Large-scale economic changes tend to come through with lag effects. So we would say that it will still take time for things to pick up. But clearly, we do believe that we've hit the trough as far as the macroeconomic despondency is concerned, or the bearishness from a top-down point of view is concerned. Two important developments have occurred which we think are very important for going forward. The first is the trend in interest rates. I think with inflation coming to a more manageable level now, with the government clearly showing its intent towards controlling the fiscal deficit, it has encouraged the central bank to initiate its first set of interest rate reductions. That's a phenomena that we were hoping would come last year, but clearly had got much delayed. We've entered 2013 and January 2013 with a rate cut. And we're quite hopeful that if the current trend of inflation continues, we will hopefully see interest rates reducing further during the course of the year. Now, an interest rate reduction is very important from an equity standpoint. We've seen this globally. As interest rates go down, valuations of companies tend to improve. So one important development, therefore, was falling interest rates. The other equally important development is the fact that earnings growth of companies, or profit growth of companies, now again seems to have bottomed out. As I've mentioned earlier, before, business confidence is improving, and we do believe that that will transmit into more robust earnings growth for corporate India in the coming years. Now, the twin effect of rising earnings growth and interest rates falling it tends to be very positive for equity markets. What we've noticed in equity markets, and not just in India but globally, is that equity markets value the spread or the gap between interest rates and the rate of return of business of corporates. So if we look at corporate India as a whole, and we look at the return on capital, which is nothing but the profits that companies are generating on the balance sheets that they have, for a shareholder or for an investor, that is the return that they will derive over time. So the return on capital produced by the company is the prime driver of your returns in terms of shareholder returns from that company. And the higher the gap between the return on capital of corporate India and interest rates, that is the value that is being added by the corporate sector. So for instance, if interest rates in the system are 8%, and if the return on capital employed of corporate India or return on equity is 17%, The 9%, which is 17 minus 8, is the value being added by the corporate sector. Now what we've noticed is the markets react to this gap. So if interest rates are rising and this gap is reducing, that's normally bad for markets. It's conversely, if return on net worth is rising and interest rates are falling, that tends to be very positive for PE valuations and for markets in general. And our sense is that after a 4 or 5 year period where this gap has been narrowing, mainly because of the fact that interest rates were rising and profitability of companies was growing at a suboptimal level. We had corporate earnings growth of 8 to 10% over the last 4 or 5 years, which is below average. As a result of which the return on capital or return on net worth of companies has also fallen. For the last 4 years, therefore, we've had a reduction in this gap, and that has not been good for equities, and we all know that equity markets have delivered virtually no returns in a 5-year period since the peak of 2008. But going forward, the important question to ask ourselves is this gap likely to increase further or decrease further? And our sense is, with interest rates beginning to come down and return on capital or return on net worth of companies beginning potentially to rise, we believe strongly that this gap will increase over the next 2 or 3 years, and this will be the primary driver of positive returns from equity markets. So we looked at the data over the last 30 years and wanted to analyze over what time frame of investing do you tend to actually start making serious money. Now what we've seen is if you invest for a 1-year period at any point in time in the last 30 years, the probability was more or less equal that you would come out with a positive or a negative return. But as you increased your duration of holding, the probability of a positive return at the end of your period of holding starts increasing significantly. And the best probability starts emerging over 5-year periods of holding. So for instance, in the last 30 years, if you had bought into the index from your date of purchase, the probability of making money at the end of a 5-year period has been shown to be more than 90% over the last 30 years. And the probability of losing money is less than 10%, which are very good odds to invest in any market anywhere in the world. And the average return of holding for a 5-year period over the last 30-year period that I'm talking about was about 17% per annum, which is also a very healthy rate of return. Now interestingly, the reason why I'm saying all these statistics is we need to put it in today's context. Today we are sitting at a point where over 5 years the return of the market has been flat to negative, which means that today we are sitting in one of those rare less than 10% of the time probability events where markets have not made money over a 5-year cycle. And typically what we've seen is when you sit in those periods of time, the next 3 or 5 years tend to produce above average returns because the market does come back. Over a 5-year period, we've had profits growing 8 to 10%. The market is back to the same level that it used to be, which implies that the P multiple or the value you're paying for profits has come down significantly. So we're sitting at a point where now P's are reasonable, interest rates are falling, return on capital can rise, that means value addition is increasing, earnings growth is likely to pick up. Over 5 years the returns have been flat, and all of that convinces us that the next 3-year period has a very high likelihood of making very good above average returns, we would say, from equities as an asset class. And I would encourage all investors watching this video to go back and just revisit your asset allocation. And this is as good a time as any in the past when we're fairly convinced that the next 3 or 5 year cycle will be very strong.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.